This month on the Buy-to-Let Mortgage Market Update, these are the topics that I'll be covering. As usual, I'm going to start off with interest rates, what's going on in the market with not only the Bank of England, but mortgage rates. Next, I'm going to be talking about a real change this year with buy-to-let mortgages, where you might already be seeing that products now come with these what appear to be excessive product fees. Historically, they've only been £1,000 perhaps. Now we're seeing 3% arrangement fee, 5%, maybe 7% arrangement fee. What on earth is going on? I'll let you into what the lenders are thinking, what's behind it, some context, if that's of interest to you. I then want to talk about top slicing. Bit of jargon, but really, really useful for those of you that are looking to buy properties with modest amounts of deposit, or you're struggling to release the equity that you need to go and capital raise and do your next project, and you're being told that you can't release what you need to. Top slicing may well be the answer for you. And finally, I want to talk about life insurance and how on earth can you save up to 50% on your life insurance premiums. It's a type of life insurance product called Relevant Life. It's been signed off by the HMRC and there's significant savings to be had. So if you are a company owner and you've got life insurance, you must be listening to this last topic. In this piece, I want to talk, as usual, about interest rates. That sets the context. We've had 14 consecutive rate rises. Do you know what? In less than 2 years. Ouch. And we've got an interest rate for the Bank of England perspective at 5.25% right now. So what's the view? What's the prediction? Let's get the crystal ball out and try and take a little snapshot as to what is likely to happen of this coming months. Well, at the time of recording this, we're on the 13th of September. So we've got the MPC, the Monetary Policy Committee meeting, I think in the 21st of September. My personal view, I think the jury's out. I think it literally is, I'm going to sit on the fence on this one and not make a decision. I think it's 50-50 which way it could go. Inflation is on its way down, finally, which is the Bank of England's job to do that, and they're using interest rates as a blunt tool to force inflation down. So that is working now. Andrew Bailey being the governor of the Bank of England, came out last week and pretty much strongly hinted that interest rate hikes are pretty much done and dusted. So there's a clue. But hey, what does he know? It reacts to lots of external stimuli. So that may or may not change. But this is really why I guess, from my perspective, the jury's out on this one. If it does go up, I think there's possibly another 0.25% if it does rise next week to be added on. It'll be modest. It'll be nothing significant. And then for the rest of the year, notwithstanding what might happen on a global scale to turn the world upside down again, then I wouldn't expect there to be any other Bank of England rate hikes so long as that inflation continues to drop down towards the 2% target that the Bank of England have set. So if you're on a standard variable rate, then of course you're extremely interested in what's going on with the Bank of England, because that impacts directly on your mortgage rate, which may well go up another 0.25% this month. So, and there's 1.5 million of you guys out there, still a large number of people for various reasons still on SVR, on variable rate. So of course you are interested in what happens. But what about the rest of us? What about those who are coming to the end of their deals and are looking to lock into another deal in the next few weeks or the next few months? Or perhaps you are thinking of purchasing another property, even residential or buy-to-let. So I think what I'm about to talk about next really does apply whether it's whether you are buying a buy-to-let or refinancing one of those. So my last question here on this slide is to fix or not to fix. What should we be doing? Historically, in a rising market, as we've been seeing in the last year, then fixing has been, frankly, I reckon 99% of the mortgages I've done have been on a fixed rate basis. But in recent months, lenders have been coming out with an alternative. And I really want to stress this point. This is important that you understand that don't get blinkered in just thinking that fixed is the only option. If you believe that mortgage rates have topped out, and I do, I think mortgage rates, as I've said here, are stable. They've been stable now for a few months. If anything, they've even been dropping marginally. Now let's not get too overexcited at this point. These are modest drops. It's not about 0.1, 0.2% of a drop on mortgage rates. Now, why would that be if we've got Bank of England rates still potentially on the rise? And I'm saying mortgage rates not only not rising, they've been stable, and in fact, they might be dropping a little. Look, I've really thought about this, and the only thing I can come up with is that banks and lenders, mortgage lenders, are actually hurting because they're not doing the business levels that they were doing early on and certainly last year. So they need to get that business in just like anybody else. So I think it's just a reaction to, the competitive market that they're in. And they're just trimming the rates a little bit, so they're getting a little bit higher up the league tables and getting a slightly bigger share of business. I think it's no more than that we should read into it. But happy days, if they're prepared to cut the margins a fraction more, then we'll take that, won't we? So back to my point on fixed rates. Should we be fixing rates now, or is there an alternative? Well, like I say, if you believe that mortgage rates have topped out, then looking at the alternative, and the alternative being that there are now discounted variable rates out more than I've ever seen this year. And I'm going to be really generic here, so you've got to take this with a little pinch of salt. Fixed rate at this level, discounted variable rates, this is on buy-to-lets, are set lower, generally lower than the fixed rate alternative. And let's say that differential is about 0.5%. So here's the question. If you're of a gambling type, then, and you think mortgage rates have topped out and might even drop in the medium term, then leaning towards actually a discount variable where you're already 0.5% lower than the fixed rate is really attractive. Even if the Bank of England do put rates up in a week's time by 0.25%, okay, you've got 0.5% margin, that's been halved now, but you're still 0.25% cheaper than your fixed rate. And if you think rates are going to drop in the future, then you might get the benefit of those savings going forward. So really attractive. But here's the thing, in addition to what I've just said, discounted variable rates quite often come with modest redemption penalties, or even, get this, no redemption penalties whatsoever. So therefore, what if you're wrong? What if your crystal ball wasn't working and actually you've taken a discounted variable rate, but then the Bank of England start to put rates up even further because of some crisis or inflation isn't dropping or whatever's going on? The Bank of England start to put rates up and ratchet it even more. And you think, oh my God, what a mistake that is. If there's no penalties, you can jump out of your discounted variable and onto a fixed rate relatively easily. So that makes discounted variables really attractive. So if you're looking at buying or refinancing right now, you'll get your broker to also look at discounted variables, not get blinkered into just thinking about fixed rates. Now, one of the downsides of a discounted variable is if you're really trying to push the borrowing. Again, just talking about buy-to-let specifically, if you're trying to release equity on your deals come to an end and you want to try and access and capital raise and pull some of that equity out, or you buy in and you're restricted on your deposits, so you really need to maximize the borrowing that you can get, then the longer term fixed rates, the 5-year fixed rates, without exception, lenders are more generous in what they'll lend to you if you're prepared to take a 5-year fixed. So it might be that you have to have that long-term fixed rate because of your situation. But if that's not the case, then absolutely let's put discounted variables onto the table to compare and contrast. So So I hope that has been of some use to you. If you're thinking, or should I say, if you're coming to the end of the deal and you're about to look at some options and you want to speak to a broker about that wider options of mortgage products, then there'll be a link to our diary. Speak to the team, no obligation. We'll give you all the facts and figures. We'll actually give you the advice on fixed and the variables to make that decision. If it doesn't suit you, chuck them in the bin, walk away. You know, all it's cost you is a little bit of time. Okay, in this piece, I want to talk about, as the headline says, fixed rates and lender product fees. It's been a growing trend this year for lenders to ratchet up the product fees associated with a buy-to-let mortgage. You may already have seen that if you've already engaged with a broker to review the deals that are out there. And you might be somewhat shocked, surprised at what on earth is going on. So I'm going to explain what's going on, what the context is behind the scenes, why lenders are doing what they're doing. Because historically, a buy-to-let mortgage, quite often you'd see a 999 quid product fee tagged on with a particular product, and that's not been unusual. And you might even see a 1% arrangement fee. What we've seen this year is those product fees go from 1% to 2% to 3 to 4 to 5, and there's an eye-watering figure, a 7% product fee. And on the surface, that is extremely hard to digest. If you've got a £200,000 mortgage and your broker's saying there's a 7% arrangement fee, then that's a £14,000 extra charge that you're going to, it's going to not only stick in the throat, you're probably going to tell the broker where they get off, or it would seem that that's the natural reaction. But again, let's get under the surface and understand what's going on. So why is it happening in the first place? Okay, so right now we've got this strange situation, where mortgage rates, again, I'm going to use my hands as a barometer here. Mortgage rates have doubled and some in the last 12 months. Rents, which is my other hand, are starting to rise, but we haven't got parity yet. Our rents have not caught up with the new cost of borrowing for our landlords. So right now, with rents being lower, we've got a lot of buy-to-let landlords that cannot get the borrowing that they need because the rent cannot service this higher level of debt right now. Eventually, because that's the way the market works, the rents will catch up and normal service will be resumed. Will that be another year? Will it be 2 years? I can't say. But right now, with rents being lower, that's the issue. And so not only have landlords not able to buy the properties with the usual 25% deposit, or they can't refinance and get the extra borrowing out that they could have done last year, also lenders are hurting. They're not lending to the same levels because of the exact same problem. The formula that is used to calculate affordability, to convert rent into what can be borrowed, is not at the discretion of the lender. The lender is not setting this formula. The regulator dictates the formula, and the lender has to adhere to that. But here's where the lender's got a bit innovative. They know, of course, that this formula looks at the rent, and the rent, as I said, has got to cover the mortgage debt at a prescribed interest rate. So the lenders thought, if we artificially reduce the interest rate on a product, that means the formula becomes more generous. But hold on, how am I going to make my margins? How is the lender going to make the profit? Well, if they artificially lower the rate, okay, they don't make the profit from the interest rate, so they now are loading the product fees. And the product fees are outside the formula. So the lenders getting their full margin that they would have done in previous years, but instead of charging a more market-led interest rate, they're essentially undercutting, artificially lowering that interest rate and but having to then load up the product fee instead. And that's what we've been seeing from significant number of lenders this year who are having to load these product fees so that you guys can still get the borrowing that you want. But on the surface, to a landlord, it looks like the lender is almost profiteering and just trying to take the mickey and get more profit by upping the arrangement fees. I hate to defend lenders, but on general cases, that's not happening. That's what they're trying to do. They're having to essentially do a loss leader on the rate, but then push the product fee up. So that gets round this stress testing, this formula that I've just described, which means that you guys can get the borrowing that you want and move on with your property plans. So in reality, when you are talking to a broker, it can be a little difficult to understand what's the most cost-effective route for me, because if a broker's offering you what looks like a relatively cheap product with a really high fee, you could be in danger of just throwing that out into the long grass simply because you've got this eye-watering large fee. So how do you work out what's best value for you? So I want to just show you a couple more slides for you to use as a simple method, simple calculation. So you could be doing this yourself. If you're doing your own research, then it'll be something that will be useful for you to do. But understanding how to calculate, I think, is a good exercise to go through. So here's two mortgage products that I've picked up in the last week. One from Precise Mortgages. It's a 5-year fixed, it's 5.24%, and it's got this eye-watering 7% product fee. As an alternative, Paragon, literally in the last few days, have come out with what looks like a fabulous 2-year fixed at 4.59. We don't often talk about mortgage rates under 5% in the last few months. Paragon have now pushed this rate down well below 5%. And it's got a lower product fee. It's got a 5% fee compared to the Precise 7%. So on the surface, you could be going, well, Paragon looks like the best deal. The interest rate's lower and the product fee's lower. Is it the cheapest? Well, this is one way of trying to work out what's the best value for money. Which should I go for? And this is if we're just looking at cost alone. So this is what you should do. So let's start with Precise. You take that 7% figure and you divide it by the 5 years because it's a 5-year fixed. So take the 7, divide by 5, and you get 1.4. Add the 1.4 to the interest rate. And now you get an effective rate of 6.64%. Do the same with Paragon. It's got a 5% arrangement fee, but it's a 2-year fix. So divide that 5% by 2, getting you 2.5%. Add that to your 4.59, and lo and behold, you get 7.09. So actually, if you do the calculation on cost effectiveness based on this formula, you actually now see that the Paragon deal is more expensive, and the Precise mortgage that had that 7% fee is now a cheaper alternative. Now, look, it's more complicated than that because one is a 5-year and one is a 2-year, so there might be other issues that you've got, other factors you want to take into account. I get that. I'm simplifying it. But that's a good starting point to try and calculate where landlords are now being offered these products with these crazy fees. And it's one way of trying to get that, being able to do a valid comparison across a range of products. So I really hope that's been useful to you in trying to understand a little bit more about mortgage products. If you've about to embark on reviewing your finances and you want to speak to us, again, there'll be a link at the end of this. Have a chat with the team and we'll do our best to put it in terms, in a language that you understand and helps you make a decision and you can go forward. In this section, I want to talk about a phrase, it might be a bit of jargon, called top slicing. I'm going to explain what it is so you understand it. But it's become a real more important policy change with lenders this year. And the reason it's come to the fore, and the reason I want to mention it so that you guys understand that it's out there as an option, so you don't get a little too disillusioned, maybe dismayed when you're trying to borrow extra money, you're trying to release equity, you're trying to capital raise, or you've got a finite amount of deposit and you're trying to purchase a buy-to-let, and you're being told by the lender that the rental income isn't there, the affordability isn't there, and you're going to have to put more deposit in, or you can't capital raise to the amount you want. You thought you wanted £20,000 to £30,000, and the lender's saying we can only release you 2,500, a fraction of what you wanted, and you're starting to feel a little disillusioned. This is where top slicing comes in. So, what it is essentially a set of rules that allows the underwriter in these circumstances where the rent is lower and doesn't quite service the debt. So the mortgage borrowing is up here and the rent, as we know, is rising this year, but quite often now the rents are not in parity with the mortgage debt. So the rent isn't covering the mortgage debt at a set interest rate. There's a gap, there's a shortfall, which is why you're getting this bad news from the lender. So what the underwriter is allowed to do when top slicing is within the policy of these lenders is to look at your earned income. So let's say you've got a trading business, or let's say you are salaried, you go on PAYE, you've got separate income. The underwriter looks at your earned income and sees if you've got disposable income. So let's just put the property to one side for a second. They'll look at your salary, look at your income, look at your outgoings as an individual, nothing to do with the property, and calculate what residential debt you've got. Have you got a residential mortgage? Have you got personal credit card debt or loans? And the underwriter deducts these outgoings from your salary and tries to take a view on whether you've got some disposable income. And if they believe you have, well, here's the thing. You get the extra borrowing because the underwriter now adds the disposable income to the rent. So the rent gets artificially inflated, and all of a sudden, this new rent figure can service the debt that you're wanting. So it's a sidestep to the issue that many, many landlords have got, that the rental income does not service the debt. And this is how top slicing can come in and save the day. So it's now been embraced by many lenders. I did a calculation, a count just in the last few days, preparation for this. And there's over 30 lenders, 30 buy-to-let lenders now offering this top slicing. So this is really important. If you're using a broker in an estate agency, and they mainly do residential mortgages and dip the toe occasionally at doing the odd buy-to-let, it would not surprise me if they've never heard of top slicing. They're not that familiar with it, or they find it complicated and they avoid it, or they're a bit lazy. So the first lender didn't offer top slicing, you've not got the borrowing you want, and they're not quite sure where to go to as a plan B. Then you want to be using a broker that really understands the buy-to-let market, understands that top slicing is an option for many of our landlords, particularly in 2023, when you might be struggling to get the borrowing that you want for that purchase, as I said, or refinance. So if any of this resonates with you, if you want to talk to the team, there'll be a link to our diary, book on there, it's free, have a chat, they'll give you the feedback, they'll give you absolute solid advice, independent mortgage advice to allow you to make a decision, and hopefully we can assist in that regard. In this section, I want to talk about an eye-watering headline here. Look at this. How can you save up to 50% on your life insurance premiums? So now this says if you're a company owner. This is something that is not just a a tip or a trick. It's been signed off by the HMRC, God bless them. This is an allowable way of significantly reducing your life insurance premiums. But there's going to be some caveats because it says here it's for company owners. So I'm going to have to explain. And hopefully, if I'm talking to you and you're currently paying your life insurance premium out of your own pocket, then you must be listening to this. You must be writing this down and taking some action and looking into it a little bit further to see if it's something that you're eligible for. So you must be a company owner, so limited company owner, and you must be salaried in that company. So many of our landlords have got SPVs. They've got limited companies with their property in it. But if you're not taking a salary out of that company, then that means you're not eligible in that scenario. You've got to be taking a salary. It can be a quite modest salary, but you need to be on PAYE with the limited company. It only works with level term life insurance. Now, if I'm talking jargon, I will explain to you what that means. It means that, let's say you take a life insurance policy out for 25 years and you take it out for £200,000 worth of cover. Then if there's a claim on day 1, year 5, year 10, year 20, year 25, whenever there's a claim, it will always pay out £200,000. It's level. That's as the description says. So that's the next thing. The premiums will therefore, for this life policy, be paid by your company, not out of your personal income. So if you're currently paying your life policy out of your personal bank account, then going forward, that will stop and it gets paid from the company. And therefore, as I said earlier about the HMRC signing this off, that means that you're allowed to offset your profits and treat this life insurance premium as a taxable business expense. So that is going to reduce your profit and you're going to be paying less tax. And also, here's the key thing, because the company's paying it, it's not coming out of your wages, then there won't be any national insurance paid by the employer or the employee, and no income tax paid before you get that net wage and pay for the life insurance. And that's the key point I want to make. And that's why ultimately, when you go through the maths of it all, there's up to a 50% saving to you as an individual and as a company owner by putting this through the company in this specific scenario. So I want you to write this next point down. If you're still listening to this and it's still of interest to you because it appears you might be eligible, this is something called relevant life insurance. It's a particular label. So what I want you to do is contact the team afterwards, make an appointment. There'll be a link after this piece. Jump on, speak to the team and understand it a little bit more. They'll give you more information on it. They'll check out whether you are eligible. And if you are, it's something you can move across to and start making those savings. Now, if I'm talking to the analytical amongst us, you might want to know the numbers. Now, if you're not analytical and you don't care, you're happy from what I've said that you can save this money, then you might want to switch off on this next slide. But for those of us that are the accountants amongst us or love to see the numbers, then I'm going to show you this on this next slide so you can see how those sort of savings are made. So 2 columns. On the left-hand side that's headed traditional life, meaning you're currently paying that life insurance premium out of your wages. Your salary's gone into your bank account, and from that net pay, you're paying out, in this example, I've said £1,000 a year. Let's say, 80 quid a month. And of course, the whole premise of this saving is that for you to have that £1,000 a year has come from your wages. Your wages have been taxed in income tax. They've had national insurance taken off. Your employer's paid national insurance. And so that's what I'm adding back in on these rows here. So I've added in employee national insurance. To pay £1,000 out, you will have paid in another 34 quid. You'll have paid income tax to end up with that net pay. I've assumed you're a high rate taxpayer, so there's a £689 additional tax bill. Getting a little further down these rows, the employer, which is essentially you, your company, has also paid to HMRC employers' national insurance. We've got to add that on as well. So as you can see, that total gross cost is now up at £1,962. For you to end up with £1,000 in your bank, your company has ultimately paid out £1,900 for you to have that net £1,000. Now, to be accurate, there's also then some add back here, because the £1,962 cost is a business expense, which means that your tax bill as a company reduces because the £1,900 expense is there. So I'm going to add back in, I'm assuming as a limited company, that is a 19% corporation tax bill. So we add back, we reduce that cost by £372 down to £1,589. So the net cost to you, if you are currently paying life insurance as an individual, as a private individual, the ultimate cost to the company is £1,589 in this example. Compared to the right-hand side, with relevant life, the business is paying for it straight out of the company. There's no national insurance. There's no national insurance as an employee or employer. There is that corporation tax deduction, but it's a lot less. It's 19% of £1,000. So there's an £810 benefit. But look at the bottom line here. Would you rather pay £810 a year or £1,589? Or depending on your own tax situation, it might be somewhere in between. But in this scenario, it's a 49% tax saving. So here's the point. The point is that there's likely to be a significant saving to you if you are a company owner that's currently paying life insurance out of your personal pocket. So take the time out, speak to the team, understand it a bit more, get more information on it, let them do an assessment, see if you are eligible, and you could start to save some of this money. I really hope that's been of use to you today. Here is the contact details. If you want to make that appointment, that's a link through to our online diary at the top of the screen. So take a screenshot of this, make a note of it, click on there, cut and paste it, whatever you want to do. If you want to ring the office in the old traditional way and book an appointment, you can do. There's the office number. If you want to get a bit more information about us as a company, if you don't really know who we are, then you can jump onto our website if you want to get to know a little bit more about the company and what we're up to. And finally, here's just a little snapshot of the services that our company offers. As you can see at the top, we've got all types of insurance, life, critical illness, income protection, short-term finance in terms of bridging. If you buy in but you want to be flipping it and selling it pretty quickly, then again, there's particular types of finance for that. Semi-commercial, commercial mortgages, development finance, all the different types of buy-to-let mortgages, HMOs, multi-unit, traditional long-term buy-to-let, holiday lets, service accommodation. Of course, we do residential mortgages as well. So anything secured on bricks and mortar is the bottom line. So if you think we can help, then, as I said, jump on our online diary, book some time in, and we'd be delighted to see if we can indeed help you. Other than that, thank you so much for sticking with us during this video. If you love what we do, then please like and subscribe. It'll be a little button underneath. I really appreciate you doing that. It really helps us. It says that people are watching, people are listening, people find it useful, and that means we'll continue providing the content that you want.